Investing in the stock market is one of the most popular methods to building wealth. Having an understanding of how shares are created and managed by companies can assist you in your decision-making process of thinking about or planning to make a purchase of shares within a specific company. Welcome back to my channel. My name is Reese. In today's video, I'm going to be talking about how shares are issued, created, and managed by companies. Firstly, I just want to clear something up, and that is that shares are for a particular company, whereas stocks is a general term used for shares. As an example, you wouldn't say, I have stocks in Apple. You would say, I have shares in Apple, but I own stocks in various companies. Companies issue shares which provide buyers with fractional ownership of their company, and these shares can be issued both privately and publicly. Companies can also offer these shares to founders, early investors, and employees of their own company to purchase. The other way that companies issue shares is by going public. When a company is listed on a stock exchange, anyone who has a brokerage account can buy these shares through that brokerage account publicly. Leading on from that, the standard way to own shares is to purchase and sell them through a brokerage account. Now in Australia, a couple of the popular ones that people use are things like CommSec, Raise, Selfwealth, and Stake. These are just some of the more commonly used brokerages here in Australia. For a more extensive list, I have left a link in the description down below. On top of this, again, I definitely intend to make some videos about what brokerages are, how they're used, and what they're useful for. So make sure you're subscribed so you don't miss out on that content. There are no rules which dictate how many shares can be made available for a specific company. Rule of thumb and a bit of logic would suggest that the more shares in circulation or existence would mean that each share represents a smaller portion of the company. An example being Apple and Amazon, they have billions of shares. They're just worth a lot in consideration of how many shares there are. Fun fact, at the time of recording this video, Apple has in circulation approximately 17 billion shares, which it would probably be pretty safe to assume that there are millions of shareholders of that company. That's why it's favored as one of the most popular stocks out there, and it is a trillion-dollar company. When share prices get too high, companies can do something called stock splitting, where they split each share into two, and that just divides the value of that original share by two as well, making a $100 share split into two, now worth $50 each. So generally the person who holds the shares, let's say I had one share in Apple and the stock split happens at $100, I now have two shares in Apple at $50 each. I haven't lost any value. It's just now the company has made it more accessible for people who don't want to spend $100 per share and instead want to spend $50 per share, giving access to more availability into their company. In simple terms, a stock split is not a bad thing. The shareholder retains the value of the shares that they once owned, and ultimately it just gives more access to people wanting to invest in that company. So now let's get into the more juicy stuff. So companies will often pay dividends to people who hold shares within their company. This means that the owners of those shares will have their accounts credited in the form of a dividend. Think of it as the company saying, thank you for trusting us with your money. It's a thank you payment because they use that money to invest in their own company and build themselves up, build up their profit margins, and you get a small piece of that pie depending on how many shares you have. Dividends are usually paid every 6 months or twice per year, depending on the dividend, depending on the exchange that you're trading on and the shares that you're buying. Definitely do your research, but rule of thumb I've found is every 6 months for the shares that I'm invested in. Just keep in mind that not all companies will pay a dividend, depending on if they're trying to grow quickly. A company that's building new factories and stores will need all that capital to build it quickly. So again, do your research into the companies that do pay dividends and have an understanding of when they pay them and in what format. Generally, investors will look at the earnings of a company to determine whether or not they are a good investment. They do this by looking at the quarterly earnings report. It's something that all companies need to announce to the public, and they can be accessed online at any time. So definitely do your research into those companies by looking at their quarterly earnings report to see if they're profitable, to see where their cash flow is, to understand if it's a company that is doing well or not so great. It's also important to understand that the value of shares is completely derived from someone's willingness to pay for it. So if a company announces that they're developing this cool new technology that sounds really promising and it starts becoming hyped, let's say, and the demand for it starts going up, the share prices are going to do the same thing and go up. Vice versa, something detrimental happens, I don't know, like a global pandemic and people can't fly around the world, you would think that airlines' share prices are going to go down, which in hindsight they have. This is a direct result of people going, okay, no travel is going to happen, therefore I want to sell my shares, therefore the market is flooded with people's shares, therefore prices again go down. In summary, if you own a few shares within a company, it means that you own a teeny tiny portion of that company. And therefore, because you own a teeny tiny portion of that company, you should be entitled to some of the profits, which are generally repaid to the investors in the forms of dividends and growth of their share price. So as the shares go up, you technically make money on your initial investment. Investing is complex in my opinion. When comparing it to something like real estate, I think that investing is way harder. There's a lot more logistical processes involved and there's a lot more to understand. With volatility in the market as well, it can be something that for the people who aren't super risk savvy, it can be a little bit stressful too. That's why I'm ranking it as something that, in my personal opinion, is complex. Overall, this video was supposed to be a brief overview of what shares are, how they're created, how companies issue them, and some of the payment methods that they offer to people for investing in their companies. If you did enjoy today's video and you did learn something, please consider liking and subscribing. It really helps the channel. I can't even believe I got over 100 subscribers. It's crazy to me. Not the point though. Overall, I hope you enjoyed today's video. I hope it was useful, and I will see you in the next one.